Many of you love using RSI or the Relative Strength Index because of its simplicity and effectiveness in finding strong trends. If you're still using RSI as an overbought indicator and using that to sell, or using it as an oversold indicator as a signal to buy, then you're using it wrong. In this video, we'll help you use the RSI correctly to help you maximize your profits. Now, if you're not sure what the RSI is, no worries, we've got you covered too. Make sure you stick around to the end of the video as we've got some strategies to use on implementing the RSI correctly. Let's take a moment and get everyone on the same page as to what the RSI is. The RSI is a single line that will appear at the bottom of the chart. It is bound between the values of 0 and 100. RSI is used to indicate the velocity and the speed and momentum of the market. So for example, if we see a value that is high, like 70 or 80, well, that simply means that the market is in an uptrend, and a very strong uptrend. On the flip side, if we see a value that is down near, let's say 30 or 20, well, that simply means that the market is in a very strong downtrend. One big mistake that many of us traders make is that we want to sell when the market's in an uptrend, or we want to buy when the market's in a downtrend. Part of this could be with the way that default is set up on the RSI. If we come out here and take a look at the RSI, it automatically comes with two lines on the chart, a line at the 70 mark and a line at the 30 mark. And I think that naturally makes people want to sell when the RSI line gets above 70, or buy when the RSI line gets below 30. But this is incorrect. As we previously stated, the RSI is a momentum indicator that gauges the strength of the trend. When the market is strong and in an uptrend, go with the uptrend, go with the flow. Don't swim upstream when you can swim downstream. There are several different ways to overcome this mistake where we want to buy when the market appears oversold or sell when the market appears overbought. That's where we could look at different patterns on the chart. We could look for trendline breaks within the RSI. We could also use a multi-time frame analysis where we're identifying the direction of the trend on a longer time frame and then scaling down to a lower time frame using RSI when it becomes overbought or oversold at that time. A strategy that I want to share with you here for the rest of this video is with regards to divergences. Divergences can be very effective in spotting reversals within the market, and because RSI is a momentum indicator, it will indicate to us when the momentum is slowing to one direction and help provide some signals. So what we want to do is we want to combine those RSI divergences with other price analysis. So let's dig in. There are two types of divergence. We have what we call regular or classic divergence, and then we also have what is called hidden divergence. Both of these can appear in both directions of the market, so you could have bullish or bearish regular divergence, and you could have bullish or bearish hidden divergence. So let's start off and let's take a look first at bullish regular divergence. Now, divergence is in essence when the market, the price action, and the relative strength index indicator are disagreeing. They're moving in opposite directions. And if we take a look at Bitcoin on a 4-hour chart, we have a bit of bullish divergence taking place because we can see down here the RSI did not reach this previous low level. So the RSI created a higher low while price created a lower low. So this is divergence. This is in essence, the soldiers in the army are not following the general. If the general in this case is price action, and if the soldiers are the RSI, well, the RSI are not following the general into the battle, and then the general is going to get slaughtered. As a result, the price ends up reversing and moving higher. And what RSI is indicating to us in this situation is that we had really good, strong momentum to the downside that created this local low on RSI. And then after a little bit of a correction, RSI was not near as strong to the downside. So the momentum moving to the downside was not near as strong, and that tells us that the trend may be about to reverse. So in essence, the price is reaching a new extreme, but the RSI is not. Now this can happen in the opposite direction. So as a matter of fact, up here, we've got a situation where we've got price coming up and it's reaching a new high, but the RSI is not reaching a new high. Each high in the RSI is lower. It's a lower high, lower high, lower high, and then eventually price, the momentum to the upside is so weak that it just falls under the weight of itself, and then price ends up collapsing. And we get a really strong trend, really strong momentum to the downside. RSI reaches very low levels, which tells us it's a very strong trend to the downside. And then again, the momentum slows, and that tells us that price is about to reverse. So regular or classic divergence tells us of an impending reversal. Not every reversal is preceded by regular divergence, but a lot of times you will see regular divergence showing up when the market is about to reverse. When you do see divergence showing up, there's a couple of ways that you could trade it. And my favorite way of wanting to trade this would be using what is called a breakout trade. So let's just focus in on this bearish divergence from the top. So we have price coming up and reaching a new high. We've got the RSI that is not reaching up to new highs. And so there's a couple of ways to do this from a breakout perspective. And what I like to do is come out and you find a midpoint low. Look for a horizontal level of support or resistance. In this case, since the market was moving higher, we want to look for a level of support. When this level of support breaks, then we could use that as a signal and a trigger to enter into it. So here we've got a level of horizontal support. Price broke through this horizontal level of support, drifted lower, came back, retested the bottom side of it, and then took off to the downside. So there were a couple of opportunities to where somebody could enter into this position on this large red candle break, placing a stop loss just up above the high, and then looking for a 1-to-2 risk-reward ratio, targeting somewhere down here. That's one possibility. Or even if they caught this retracement, this wick retracement, could be the same thing. Could have been an opportunity to try to catch that wick using at least a 1-to-2 risk-to-reward ratio. So there are some situations where when you set up a breakout trade, it can help keep you from some losing positions. So let's go back here. The market fell very harshly in that middle of June sell-off. And you can see we've got some divergence showing up. We've got a situation where the market created a lower low in price, but the RSI indicator created a higher low. So that's the divergence. It's not syncing up. It's disagreeing with the price. And so in this situation, what you could do is you could identify that horizontal level of support and resistance. Right here is a level of horizontal resistance. And you'll notice that price did come up and rally, drifted back lower, but never really made it up to that horizontal level until much further down the road. And so this is a situation where even though it took a long time for it to come up here, probably wouldn't want to look at that as a long entry on that breakout. And that's because by the time price came through here and reset itself, there really wasn't any momentum to the upside. If there was momentum to the upside, it would have gone up and it would have broken right up through this horizontal box. But it never did find any momentum to the upside, and then eventually just kind of meandered sideways. Had somebody taken a position, it might have worked out, might have not, but as you can see, it just was not as good of a situation as it was in these others where there was an immediate break in price through that horizontal support. And so you want to look for how quick the market responds after that regular and classic bullish divergence or the regular and classic bearish divergence. Now let's move on to the second type of divergence, which is hidden divergence. What hidden divergence is basically it's the opposite, where RSI reaches a new extreme, but price does not reach a new extreme. And so we have an instance of hidden divergence right here. This low to the right did not reach a new price extreme. But when we look at this to the downside, notice how the relative strength index, the right dip did reach a new low below the left dip. This signals a continuation of the trend. So whereas the regular or classic divergence was a signal of a potential reversal, hidden divergence means a continuation of the trend. So going into this divergence, we had a trend to the upside. We have hidden bullish divergence, and then the market ended up continuing higher. The way somebody could trade this is similar as before. It would be bullish divergence, so you would look for a level of resistance to break. When that level of resistance breaks, then you could look to initiate a long position. And so if your entry is somewhere here inside this box, you could come up here and place a stop loss. Depending on how you enter, if you enter on this breakout, you're going to want to place a stop loss down below this recent swing low. If you're entering on a retest of this box, you could be a little more aggressive and tighten up that stop loss. But I'll just leave it down here for now. And then you'll notice that subsequent price action easily made it up 1 to 2, almost a 1 to 3 risk reward ratio. So that for every point of risk, there was at least 2 points of profit potential on it. Okay, here we're taking a look within the month of May on a 4-hour chart for Bitcoin. This is an instance where price was consolidating sideways, and RSI and bearish hidden divergence was giving us a clue that we may see a breakdown here in the price. So you'll notice that after this local low, we had regular bullish divergence, okay? New extreme in price, but not a new extreme in RSI. This signals that the momentum to the downside has slowed. Well, in essence, basically what was going on is price was consolidating sideways. And as price was consolidating sideways, notice how these high prices were getting lower and lower and lower. As those high prices were getting lower and lower, we started to see RSI generating some higher and higher values. So this is hidden bearish divergence, and this suggests that we may see another price move to the downside. Now, eventually prices did drift down and broke through this support level. It didn't break it by much, but eventually we did see prices push down through this support level, but still not enough energy for it to break down. But that could have been our initial clue. There was still some weakness out in the market as the market continued to drift sideways. Now, if we go back even farther here, here's a really good example. We've got a situation where prices are not reaching a new extreme, but we do have RSI just barely reaching a new extreme value. And so this indicates that there would be some weakness ahead. And again, this is where you could use horizontal levels of support and resistance like this. You could also come out and you could use a trend line connecting these two lows and then waiting for a break of it here. It both ends up in about the same place, where you would look to initiate that short position somewhere around here. And if you place that stop loss up above the recent swing high, look to target at least twice as much as the level of your risk. And so you would be looking for a target somewhere down here. So that would be hidden bearish divergence, where the RSI is reaching a new extreme value, but price is not reaching that new extreme value. Now, one thing I want to point out to you is, as you're just new into learning this and trying to figure out how to spot this, I've got a couple of tricks I want to share with you. The first trick, we spoke earlier in the video about how a lot of charting packages will use the 30 and the 70 setting. We'll use that as a level of overbought and oversold, and it can confuse a lot of people. So there's a couple of things that we can do to tweak this. First of all, if we change the source of our RSI setting, if you use OHLC, open, high, low, close, and divide it by 4. Software package does this automatically. Where that comes into handy is in these situations where you have some wicks to the upside. Most charting packages default to just the close. And when you're looking at the close, basically it's just a line chart that you're looking at. And that's okay. But if you want to get a little more precise, leave it on a candle, leave it on a bar chart, but change it to OHLC4, which is the open, the high price, the low price, the close price divided by 4, and then that gives you the average value. Basically, it takes into account the wicks associated with each candle. The second adjustment that you can make to the setting on the actual chart is you can get rid of the upper and the lower band and just leave the midline. The midline would show up near the 50 and turn off the background as well. So this midline near 50, if we focus in on this, the hidden divergence appeared near the midline. And so some traders will use the midline as also a trend a way to determine the direction of the trend. If RSI is above the 50 value, then they would consider this to be an uptrend. If RSI is below the 50 value, then they would consider it to be a downtrend. And so here, notice how RSI dipped down to about 25 and then rallied back and really couldn't rally much up above that 50 level. That would indicate that it's having a hard time rallying back into an uptrend, and then it ended up falling down and spending the majority of the next several days below the 50 mark. So that's one way that you could pick up some clues as to whether to look for regular divergence or hidden divergence. Hidden divergence a lot of times is going to happen around the 50 mark, whereas the regular divergence a lot of times is going to happen near the extreme levels. So there's another tool that I want to share with you. If you come up into indicators, type in divergence. So it's this divergence indicator. What this divergence indicator can do, every time there is bearish divergence, remember we highlighted this before, bearish divergence, here's bullish divergence. It will also throw out, so for the inputs, 14, let's change this to OHLC4. Okay, and then we also want to check the box, plot bullish, plot hidden bullish, plot bearish, plot hidden bearish. Okay, and so here's hidden bullish divergence, here's hidden bearish divergence, and so it will plot every instance of this showing up on the chart. Just because it shows up down here doesn't mean you necessarily want to trade every instance. You want to bring into it an element of price action analysis, wait for level of support or resistance to break, do some trend analysis as well. Like in this instance here, we have hidden bullish divergence, but the RSI, this occurred well below down here when RSI was near 30. And so therefore the move to the upside just wasn't as strong. There was a little bit of a trend, but it wasn't as strong because RSI struggled near that 50 mark. But ever since then, notice that we had all these hidden bearish signals when RSI was well below the 50 mark. So you want to use that as a means to couple with normal price action analysis, using support and resistance levels, looking for levels of break, and couple that with RSI. So that's how you want to use the RSI rather than just a simple overbought and oversold. So as you can see, buying when RSI is oversold or selling it when it's overbought is not a viable strategy. And even using RSI and just that divergences by itself is not a strategy. RSI divergence is a tool that can help you spot some trades when you couple it with other forms of price action analysis. And that is looking for horizontal levels of support and resistance, or even trend line levels of support and resistance. And if you spot divergences on a reversal, so let's say it's a regular classic divergence, and then you see a trend line break, well, that would be an instance where you could enter into the position looking for at least a 1-to-2 risk to reward ratio. So if you like what you see here, go ahead, press the like button, go ahead, subscribe, and make sure you check out our other video. We've got one here on moving averages and uses that you could use for it. So we'll see you in the next video.